Hello everyone. In today's session, we will start from point number 3, voucher. Now, what is meant by voucher? It is a document which provides the authorization to pay and on the basis of which the business transactions are first of all recorded in the books of accounts. Now, it can be a piece of paper like cash memo or any other document which gives us a proof for recording the transaction in our books. Okay, so a separate voucher is prepared for each transaction and it specifies the accounts to be debited or credited. Now, the rules for debit and credit we will learn in our subsequent sessions, but for now you remember that voucher, if for example there is no document or proof of any business transaction, then in that case we will prepare a separate voucher in which we will specify the accounts which are involved as well as the amount. Now, the vouchers are prepared by accountant and each voucher is numbered and countersigned by an authorized person of the firm. Now, when we prepare voucher, it should be prepared by an accountant and not by anyone else, and after preparing it, it should be numbered, means there should be a number in voucher, for example voucher number 300 and something like that, and it should be signed by an authorized person, either the manager or the owner of the firm. The next is discount. It is an allowance offered by the seller of goods out of the selling price of goods or a deduction for making prompt payment. Now, discount, as we all know, it is a benefit given by the seller to the consumer or customer. Okay, now it is given on the selling price and not on the cost price, or it can be a deduction for making prompt payment, means immediate payment. Now, when we talk about discount, there are two types of discount. First one is trade discount. When discount is allowed by a seller to its customer at a fixed percentage on the list or catalog price of the goods, it is called trade discount. Suppose when we see a chart in the or a catalog in which the amount or the price of the commodity has been mentioned, now trade discount is given on a fixed percentage like 20% or 25% on that marked price of goods. It is not recorded in the books of account. Now, this is important rule that you have to remember, that trade discounts are not recorded in the books. It is deducted in the invoice or cash memo. When we prepare cash memo, then in that we will deduct trade discount from the amount, and the deducted amount that appears in the cash memo, that means after deducting trade discount, the balance amount of good that is recorded in the books of accounts. And the thing that you have to remember most is trade discounts are not recorded in books. Okay, now cash discount. When discount is allowed to the customers for making prompt payment, it is called cash discount. Now, if this buyer, he makes immediate payment, then in that case the seller, he will give cash discount. For example, if a seller allows 2% discount for payment within a week, means if he puts up a condition that if the buyer makes the payment within a week, then he will give 2% discount. Then if the buyer makes the payment within that week, then he will get 2%, otherwise he will not get this 2% of discount. Now, trade discount we don't record in books, but cash discount we record in the books of accounts. Okay, now there is third kind of discount, but it is little bit different than these two. It is known as rebate. It is a reduction in the value of goods sold allowed by the seller after the goods have been sold. Now, after selling the goods, if the seller, he allows any discount or reduction in value, that is known as rebate. Now, the difference is that it is allowed by the seller for the reason other than for which trade and cash discount are allowed. Means if there is any other reasons for which the seller is giving discount rather than the reason for giving trade and cash discount, that is known as rebate. Now, let us see one example. Rebate may be allowed because of poor quality of goods sold or goods being not as per specification. Now, when you have sold any goods and it has not matched up to the standard quality, or if it is of poor quality, then the seller can give rebate. He will not give any trade discount or cash discount. Okay, The next is goods and services tax. Now earlier, before July 2017, in India we had two types of taxes. First one was direct tax, that is known as income tax, and indirect taxes. Indirect taxes were like excise duty, sales tax, VAT, service tax, and custom duties, and all those things were indirect taxes. But on July 1st 2017, Indian government, they have introduced GST, in which all those indirect taxes are combined together, merged together, and that is known as GST. Now the thing that you have to remember is that GST is paid at the time of purchase. Now as an individual customer or as owner of a business, when you purchase any goods, you pay GST, and when you sell any goods, that time you collect GST from consumer. Okay, that you have to remember. Now these were the most important terms, accounting terms, but there are some other accounting terms as well. Let us see. Entry. When a transaction or event is recorded in the books of accounts, it is called entry. Okay, now in accounts we have seen that we have to record every transaction, business transaction, in books. Now those recording of transactions or event is nothing but entry. Bad debts. It is the amount that has become irrecoverable from a debtor. It is a business loss and is debited to PL account as an expense. Now bad debts means, suppose, let's say example, that you have sold goods to a customer and on credit, means you haven't received the payment yet, but after some time that debtor or the person to whom you have sold that goods is not going to give you, or is not going to make you any payment. In that case, you have lost certain amount of money, so that is known as bad debts. Okay, debts which have become bad. So since this is a loss for the business, it is recorded on the debit side of profit and loss account as an expense. That we will see while preparing profit and loss account. Then insolvent. Insolvent means a person or an enterprise which is not in a position to pay its debts is called an insolvent. When a person or enterprise doesn't have sufficient amount of money to pay its debt, it is said that that has become insolvent. Then opposite of insolvent is nothing but solvent. A person or an enterprise which is in a position to pay its debt is called solvent. Now stores. Stores is used to denote materials held by an enterprise for the purpose of consumption in the business and not for resale. Now this kind of materials we keep in our business, we use it every day, but we do not keep for the selling purpose, and while using them we used to consume it, means the amount of or the quantity of these materials decreases day by day. Okay, example, lubricants. Lubricants we don't sell. Okay, we use it to keep our machinery in good position. So while using lubricants, the quantity we consume lubricants, but we do not sell it. Okay, so these materials like spare parts of machinery, packing materials, which are kept in the business for use and which are consumed while using those materials, are nothing but stores. Now revenue. Revenue in accounting means the income of a recurring or regular nature from any source. It consists of the amount received from sale of goods and from service provided to customer. Now every day in business we used to sell goods, or if it is a service rendering firm, then they used to provide service. So after providing or selling goods, the amount or the money that they receive is nothing but revenue. It also includes receipt of rent, commission, dividend, interest, etc. Since we used to receive rent, commission, dividend, interest on a regular basis, they are known as revenue. Okay. Then revenue from operations. It is the revenue earned by an enterprise from its operating activities. It includes revenue from sale of goods and services, from sale of, and revenue from sale of services. Now while selling goods or services, we are operating in our business, so money earned through selling these goods or services are nothing but revenue from operations. Now next is entity. An entity or business entity means an economic unit which is formed for earning income by providing service or selling goods, for example LG Electronics Wipro. Now when you form a business, that is nothing but your entity. Okay, like big companies, LG Electronics, Wipro, Maruti Suzuki, they are company as well as business entity because they are separate, they are treated separate from the owner of that business. Now turnover, more often we have heard like some people, they will say that my business has turnover of this much amount, that much of amount. So turnover is nothing but total sales that you have made in a particular period. Suppose if you want to know turnover of your business for last year, then for whole year you have to find out how much amount of sales that you have made. Total sales, it includes cash sales as well as credit sales. Then livestock, normally we know that domestic animals such as cattle or horses are known as livestock. And last one is investment, refers to the deployment of funds, means you have spent money on funds, or you have purchased shares or debentures of company. Okay, and on return of those investment, you will receive certain amount of money as interest. So those are nothing but your investment. So these were some of the important accounting terms that you have to understand properly. Okay, so I hope you understood all the topics, but still if you have any doubts or any confusion, then you can ask me so that you have clear knowledge of what any term would mean in accounting. Okay, so for today's session, let us wind up here, and from next session we will start a new chapter. Thank you.